The next approach is commodity bundling, where we could sell one product or another product, but we're better off selling them together as a bundle. An example is as follows. Let's say we have two consumers, one willing to pay $2,000 for a computer and $200 for a monitor, the other $1,500 for a computer, $300 for a monitor. So one approach might be, well, let's sell it at $1,500 and the monitor's at $200. Therefore, we'll sell both of the components to both of the customers. Our revenues would be 2 times $1,500 plus 2 times $200, total of $3,400. Now we say, well, let's try a different approach. Let's sell at the highest price. We could sell at $2,000 to make more money from the computer sales and $300, but that's even worse. We get $2,000 by selling this one to this person, and we get $300 selling that monitor to that person. Total is only $2,300. So what can we do? Well, let's bundle. Let's bundle them together and sell it for $1,800, which is the minimum of the two combined, right? 2,200 is 2,200. 1,500 plus 300 is 1,800. So we say, tell you what we'll do. We'll sell you both for 1,800. In that situation, both will say, yes, I'll buy. Two, because that's what they're willing to pay, 1,800. And number one will pay 1,800 because they're willing to pay 2,200. So they're going to feel they got a deal. But look at what happens to you. You sell two computers and two monitors to the two customers. So you earn a higher amount of revenue, in this case, $3,600. Notice here we're ignoring costs. We're just showing how we would be able to capture more of the demand if we use bundled pricing. The next situation is peak load. And in this case, here we have an express lane where if you go into the lane, you have to charge money. And that amount charged could vary by time of day. This is how peak load pricing works. Here, let's look at the demand at the peak period for the use of the toll lane. Here is the marginal revenue, and the marginal cost curve is captured here. Now, we would therefore set a price at the peak period equal to PH, right? So at this price, we would pick up our demand and we would make money getting people to use our toll road. Now, this curve here is the demand during non-peak hours, let's say middle evening. So there's going to be much lower demand because there's less traffic. And therefore, there is some demand because there may be some traffic. So there is a lower demand curve for that. Now, if we charge this amount for the entire day, we're fine during the peak period. But during the non-peak, we'd get no demand at that price. So what do? We end up with two different prices. We set one that is based on what happens during the peak hours. We charge more money. And we charge another price at the non-peak period. So then we pick up additional profit. We would get whatever profit at the peak price anyway, but now we're picking up the extra that is willing to pay the lower price during the non-peak period. So this is a way to maximize your revenues if you can differentiate between peak and non-peak use of your product, in this case, a toll road. The next condition is a cross-subsidy. We're all participants in this one, I'm sure. This is where a company sells one at zero or low cost in order to subsidize the main product that they make money on. And that's the idea of a cross-subsidy. We give away, in this case, Adobe gives away their reader. And if you want to do any editing or anything more specific with creation of the PDF, you need to buy some software from Adobe. So that's an example of cross-subsidy.